Hi, this is Scott. Welcome back to another Hollinger Team video blog. This video is about a terminology that's used in real estate that sometimes doesn't mean anything to anybody unless they've had it explained to them or they are involved in a business that uses the terminology. And the term is absorption rate. And the best way I can describe absorption rate would be just in a very basic description would be if last year in 2018 there were 100 homes for sale, and in that year 20 homes sold, then the remaining 80 homes that are still for sale at the sale of 20 homes a year would take 4 years for all 80 homes to sell at the rate of 20 homes a year. That's a very basic kind of description and not realistic, but it hopefully will give numbers that helps make sense. We break it down further to help customers in pricing strategy and can show some of the trends that are in different price ranges. And I've included some graphics in this video so that you can see it trending from 300 to 400,000, from 5 to 600,000, and from 7 to 800,000, and lastly from $1 million to $1.5 million. And the thing that I wanted to illustrate on these as we go through them is that the top half of those ranges sell at a much slower rate than the ones in the bottom half of those ranges. In other words, if we go to the first graphic, the $300,000 to $400,000 range, we've got two lines there. One is for $300,000 to $350,000, and one is from $350,000 to $400,000. You can see that there's a difference in months there that's trended over the last 3 years of about, if you do the math there, probably about 20 to 40% faster rate of sales in the bottom half of those ranges. If we go on to the 5 to 600,000 price range, you can see that there was a huge gap there. Almost in 2015, the absorption rate in the lower half of the 5 to 600 range, of 5 to 550, was almost 3 times as fast as the sales were in the upper half of that price range. It's narrowed down now, but it's still, if you look at its roughly 5 months on the bottom half of the range and roughly 10 months on the top, it's still twice as fast in the bottom half of that price range. Same kind of, a little bit of different shape graph on the 800 to 900, but again you can see that there's a trending that's starting to expand again, going into it through 2018 of 15 months versus 25 months. So basically a little over a year to a little over 2 years for the upper half of that. So there's really a pretty substantial time difference there in the amount of expected time for those homes in those price ranges to sell. If we look at the $1 million to $1.5 million, then all of a sudden it goes to a matter of 1 year versus 2 years of sales there also. I don't have a rock solid explanation for the difference in those lines in those graphics, other than my theories is that buyers tend to want to try and get more for their property, whether they need or think it's worth more or they want a little negotiating room. But if you look at the numbers of active listings in the upper range versus the active listings in those lower price ranges, it's almost a 2-to-1 ratio on all of them. There's always a spread there. And then the other thing I think sales side of it is that we see buyers that shop in a price range. If they don't find what they like, they'll look up a little bit, so they end up in the lower half of the next upper bracket from where they've been looking, and they purchase in there. So it creates more buyers in that price range also. And it's just been that way for so long. And then finally, thank you for tuning in to the Hollinger Team video blog.